Welcome to another episode of A Come Together. Paul Musson, we are live. Welcome. Did I pronounce your last name right?
You did it.
Awesome.
Very
Okay.
good. Yeah.
Well, first of all, congratulations on your book. Um, Congratulations on the book, and congratulations on your semi-retirement or retirement, I guess.
Well, it was sort of supposed to be a semi-retirement, but I think I'm busier now than I was when I was working full time. It's sort of seven days a week for sure.
Yeah.
And because I also have a free blog that goes out every week. It's called
Hmm.
Paulitical Economy instead of political. Paul, my first name.
Beautiful.
Yeah, but I love it. I love it. It's so much fun.
Yeah, well, I guess the only difference would be that, whether you're doing it for someone or whether you're doing it for yourself, because I mean, I imagine that you don't want to ever stop doing fun things that you enjoy, but as
Well,
opposed to having to do
yeah, no, that's true. But I was fortunate in that I also loved my job.
it.
I
Hmm.
was a professional investor for over 30 years. I worked for a great company. I had a great team who are now continuing on what we all built together. They're doing a great job. They were all over at my house last Thursday for our annual team golf day. So I'm still involved, but from the periphery. But it's all fun.
Beautiful,
Yeah.
beautiful, beautiful. So tell me a little bit about yourself, if you don't mind. And then we'll talk about the book and we'll talk about everything. But tell me a little bit about who you are first. Mind.
Yeah. Okay. Yeah. Sure. Yeah. Thank you. So yeah, I was
Sure.
born in the UK. And don't worry, I'm not going to go through my whole life history. But we moved to Canada as a family, when I was very young, back in 1965. And then grew up in Montreal, moved to Toronto in 1990, December 1990, just looking for work. And
Hmm.
yeah, I was literally sleeping on the hardwood floor of a bachelor apartment, like a one-room studio, and looking for work. Not even a
Right.
chair. I had no furniture at all. And my first job was in a video store. Your younger listeners probably don't even know what that is.
The blockbusters of the world.
Yeah, yeah, exactly. Yeah, and yeah, working nights and sleeping on the floor. I was 29 years old. That's how I got
Wow.
my start in Toronto.
Did you
And
ever have a vision of what you wanted to do, or you weren't
uh,
sure?
just I had a very broad vision. I knew I wanted to do investment analysis, but I was very naive about the structure of the industry, what what the industry even looked like. I just wanted to. I knew I wanted to analyze companies, do investment analysis,
Hmm.
and so yeah, so I knew that, and and that came to me very late in life, like when I was 25 or something. I was just going through university, taking all kinds of courses, not knowing what the hell I wanted to do. And my big
Right.
passion actually back then was reading stuff like philosophy and history, and I couldn't wait to finish my schoolwork so I could get home and read.
Right.
And it's like that's where I felt the real learning was. It's like Mark Twain said, I never let school interfere with my education. You
That's right. That's right.
School is necessary. Don't but yeah, and then going from one job to another, always trying to. My attitude back then, when I arrived in Toronto, was I didn't want to be a burden on anybody, either financially, emotionally, physically, nothing.
Hmm.
And that's how I sign off on my weekly blog: is be free and do no harm. And
Right.
if you focus on not doing any harm and just doing the things that you like to do, I think you're a long way there to helping make the world a much better place. And there's other things you can do too, but those two things. And yeah, so I did the best I could at every job that I took on, no matter what it was. I tried to be pleasant, and people got all kinds of shit going on in their lives that you don't know about. So why are you
Hmm.
going to make things worse for them? Why are you going to pile on top of that? Try to be a positive influence. And it's amazing the effect and the influence that you can have. You know,
Just by the way, with very minimal interaction too. Literally, just eye contact and a smile is all you need.
Absolutely, it goes a long, long way. And you can bring out the very best in good people Conversely, if you're a jerk or you're in an environment that, is a very bad corporate culture, bad
Hmm.
environment, that can bring out the very worst in very good people. And like I've been there. I can think, oh
Hmm.
my God, I can't believe I said that or I did that. What was I thinking? Well, I know what it was. It was the environment. It was a conflict. Not I'm not a bad person, but boy, that was really
Yeah.
embarrassing. It was very hurtful. I don't want to do that anymore. And
Hmm.
yeah, so just going from not a lot of jobs, but here, there, do a good job, and then I think if you do a good job and your boss and your colleagues can rely on you, then they will enthusiastically refer you to other jobs. As long as you're honest with them from day one about what your path is, and I told my one boss that, look, I'm only going to be here for 2 years because I want to be in
Hmm.
research. I was an assistant to a stockbroker. It was a tough job, and after 2 years, I said, you have to start looking for someone to replace me because 2 years is up. I want to get into research. And she said, Paul, you've been
Hmm.
straight with me from day one. I'm going to help you find a job. And I got a job on the institutional trading desk at CIBC World Markets in large part because of her referral.
Yeah.
And she's still a friend today, and she listens and reads my blog, and she's reading my book. And that was back in
Beautiful.
1994 when I left her.
That was a full year before I was born.
Yeah, yeah, yeah. I'm 63 now, so. But
There
yeah,
you
it was a
go.
very unconventional. Well, maybe it wasn't. I don't know, but it's unconventional career path. It's not like the path that they teach you to take in school.
Right. Non-linear.
Yeah, no, exactly. But it was fun, and I learned so much, and I met so many amazing people. And and then you learn about careers that you had no idea about. Like how can you know what's involved? Being an assistant to a stockbroker unless you've done it, or
Right.
being an analyst, or being in institutional sales and settlements and stuff like that. And yeah, so you learn as you go, and you know it. It's not all fun and games. There are times that you really have to bear down and see through it because as I said earlier, I was trying to do no harm and be a positive influence. Well, not everybody else around you was thinking that way,
Sure. Right.
but you can't let it get to you within reason, of course.
Sure.
And if you can't fix it, then you have to move on, and I had to do that a couple of times. And yeah, you give it the old college try. You be honest with people about what your concerns are, issues are, and if you can't fix it, then don't remain angry at those people. Just move on.
Yeah, yeah, it's beautiful advice. It's really good advice, especially. And I think what people struggle with, and I've known this, I guess anecdotally, but from a lot of my friends, would be that they prefer the familiar devil than the unfamiliar solution. Like they prefer.
Yeah,
Um, you're like, well, I know what I'm dealing with over here, and like I know what to expect, but like out there, I don't know what's going to happen out there, and at least I have the consistency, or at least I could predict within a relative, with relative accuracy, the way that my boss is going to treat me today, or the way my coworker is going to behave today. And even though it's not great, it's better than not knowing what's going on out there. I think that holds a lot of people back.
yeah, and it is scary, when you're changing and you have an income, and especially if you've got bills you got to pay and stuff like that.
Yeah.
And you might end up in a worse place. It's true, but if you do, then change that one too. you
Right.
know, just keep going until you find something you really love. Because being stuck in a stressful environment is very unhealthy.
Yeah.
For your longer term. And yeah, you want to be happy. You don't want to be just existing.
Right.
Life
Right.
is happening right now. Don't just wait and hope something better comes along or that person will change or maybe they'll leave or whatever. It's not easy to do, but it really is for your own good.
Yeah. It's beautiful. Do you think that your interest in philosophy and I guess concepts and ideas, and analyzing them is concurrent or runs along the same theme of your interest in analyzing companies and stocks and stuff like that? Do you think that it's just the way that you think and your train of thought?
Yeah, I'm not sure to be honest with you.
Hmm.
Yeah, I don't know. Like like I was
But
very
what about stock analyzing or company analyzing was attractive to you?
well, first of all, like I love math. I'm not
Hmm.
a math genius by any means. Like I was above average. I always, you know, got good marks in math, but I was definitely not a math genius. But I like
Hmm.
math. I like math.
Right.
And I like accounting. And
Hmm.
I like figuring things out. And when you're building your model, when you're looking at a company and you got your income statement, balance sheet, cash flow, I would build it all myself, input all the numbers. I just loved doing it. I loved inputting numbers and then
Right.
getting them all to balance all the three statements. And then as you're building those statements yourself, you're going year by year, you're discovering things about the personality of the management team just through the accounting. Because there's a lot of latitude in accrual accounting, like different decisions that management can make with respect to how they want to account for the business. And so that was so much fun. Oh, where's that big write-off there? Or how come they changed the depreciation here? Or, all this kind of stuff. So it was like sleuth detective work, problem solving. I always loved that challenge. Um, I loved meeting, I mean, who doesn't? Like really capable people, like
Yeah.
world-class CEOs, CFOs, very impressive people. Now you got to be careful because impressive people you can get your guard down. You
Hmm.
just you want to impress them that you know what you're talking about too. Well, no, you shouldn't be doing that. You should be trying to figure out how they're really thinking, what their long-term plans are. Do they make sense, or are they out to lunch? Um, Different businesses. Look, researching different business models. Oh my God, I never even knew this type of business existed. And
That's also that's tons of fun.
yeah, it's tons of fun. And seeing how they are wowing their customers. Their customers love what they do, and these companies reinvest in their business all the time to make the product even better, to stay ahead of the competition. When you do that, you improve your operating costs, you make more money. But what that does is that attracts competition because you're making more money, and now you have to lower your price. So if all this is working correctly without government interference, then prices should steadily decrease as companies increase their efficiency because the excess profitability gets competed away. And that's what
Right.
we should have in an economy. I'm getting ahead of myself here, maybe, but we should
No,
have
this is great.
slowly falling prices. So all that productivity growth, the hard work and innovation and research and development, like people putting their own skin in the game, the ultimate beneficiary should be the consumer. And so even
Correct.
if you have a flat wage, your income isn't going up. Every year you would be getting wealthier as your flat wage would buy more and more stuff because prices are slowly coming down. And yeah,
We know
so
it's the opposite, right? In reality, at least. In reality, we know that's the opposite.
yeah, because it's the opposite because policymakers increase the money supply faster than the economy can produce stuff. And so there's more money chasing not as much more stuff, and so the prices of that stuff goes up.
Right.
And they will tell you that inflation at around 2% is a good thing and that you need inflation for an economy to grow. No, you don't. In the, la- in the last 30 years, well, 1867 to 1897, so that 30-year period in the States, money supply growth was only about 4.5% per year. I mean, there were ups and downs,
Mhm.
but on average. Yet, the U.S. economy exploded in terms of productivity, and so you had falling prices over that time. So you had falling prices, you had deflation, not
Yeah.
inflation, in an economy that was booming,
Right.
right? So empirically, by experience, and theoretically, you can demonstrate and prove that inflation is not required for an economy to grow. And if anything, inflation of any sort detracts from the productive capacity of the economy. It's not that the economy stops growing, it just grows slower than it otherwise would have grown. And so it's the what French economist back in the 1800s, Frederick Bastiat, said that an economist needs to look at what is not seen. So if governments inflate and the economy is growing, they will say, hey, look, well, we have 2% inflation, the economy is still growing. Yeah, but what you don't see is if they weren't inflating, the economy would have been growing even faster.
Ah.
But you don't
So
see
what,
that.
so what would the argument be for people to say that inflation is necessary? I mean, I understand what you're saying now, but it can't be that. I mean, is there another perspective or another argument that people make to explain that away?
Yeah, it's largely sort of the Keynesian economic
Ah,
sort
which
of
is Keynesian
framework.
is generally that with government spending, right, or government back spending is typically the
Yes,
idea.
government. Well, the so what is called Keynesian economics today, I don't think John Maynard Keynes would recognize.
Okay.
I think it's been bastardized.
So what's the original idea and what's it become?
Well, yeah. So I think Keynes's idea that he put forth in his book called The General Theory back in 1936. You have to remember the context as well. The Western world was in the middle of the Great Depression.
Hmm.
And so he advocated for government spending. He would have said that the depression was a result of a lack of animal spirits, and that people all of a sudden wake up and they're too afraid to spend their money.
Hmm.
And if you don't spend your money, you're denying somebody else of an income.
Right.
And so if you won't spend your money, then the government will either tax you or borrow your money or print money, which takes your capital from you, which we'll talk about in a second, and they will
Uh-huh.
spend your capital for you. So they will. So the government can only spend capital by taking it from somebody else. The government
So
doesn't
it's
own
forced
capital.
spending. Yeah, the government has none of its own money.
Exactly. Yeah. Or it has money, but it doesn't have capital. So the government can print money, and
Okay.
when they print money, they take your capital. Um, So, and that's an important distinction, which we'll get to in a second. But I just want to
Which is
finish off the
capital versus money. Capital.
capital,
Yeah. Go ahead.
capital
Sorry.
versus money. But let me just finish on the
Please.
animal spirits and why policymakers are convinced that inflation is a good thing.
Okay.
It's decidedly not. And so it's not animal spirits that caused the Great Depression. I mean, it's still highly debated what caused it, but there were things like um, Smoot-Hawley tariffs that were put in place. I think it was 1930. So global trade ground to a halt.
Hmm.
All of a sudden, President Hoover, Republican, sent tax rates through the roof. There were no income taxes, by the way, until 1913.
Right.
And now, I think he took them up to 63%, I think, in 1932. And
63% on income tax?
yes, and then Roosevelt in 1935 or 36, I think he took them to 75% or something like that.
What?
Yeah, the top marginal tax rate. In the 50s, they were over 90%.
For who? How come I never
For
heard about this?
the top income. I know a lot of people. I'm actually writing about it in my weekly blog. I have a
Hmm.
book review section, and so right now, the last couple of books have been on supply side economics. I'm not a supply side economist, but I like learning about different economics, and they've got lots of
Hmm.
great stats in there. But anyways, getting off track. So yeah, so the depressions or recessions are, for the most part, a result of bad policy, either bad monetary policy, And this goes way back to the 1800s, even before there was a Federal Reserve. Monetary policy was dictated primarily by the Treasury in the 1800s. So you had the Sherman Silver Act and Bland Allison Silver Act and all this kind of stuff. But so policymakers like the idea of inflation, or people believing that inflation is good for the economy because it gives the central bank the excuse to increase the money supply and inflate. And so then that enables the government to spend more money than it otherwise could and be popular with the voters. And then when you're inflating the money supply, you're debasing the currency, you're making the money worth less. And so all the debt that you take on becomes worth less over time the more you inflate.
Mm-hmm.
So that's why governments like inflation. And then they'll use excuses like the paradox of thrift. This is one of their favorites.
What's
And
that?
so they will say that saving and investment is not a good thing for the economy as a whole because, like I said earlier, the more you save, they will
Mm-hmm.
argue then you're denying someone else of an income because you're not spending your money. But this is really fallacious economic doctrine because when you save your money, it's not like your money is not spent, it's just spent
Right.
in a different part of the economy. Your money is
Right. I was gonna say that.
invested in the part of the economy that is producing goods, in the intermediate goods part of the economy. And so they will say that, um, so let's say the example I use in my book is that central banks will tell you that if there is 0% inflation, that's really bad for the economy because people won't be encouraged to spend their money because prices aren't rising. They think that you need to see rising prices to encourage you to spend your money before prices rise. And so I use the example of, forget zero, I use the example of 2% deflation. So assume there's 2% deflation, which means that prices are falling 2% every year. So this is a central banker's nightmare, that they think the economy will grind to a halt because everybody will stop spending the money because they're going to wait for 2% lower prices next year. So assume that you have a TV and you want another TV for your basement, for your kids so they can watch it down there and not make a noise upstairs in the living room. So this is
Mm-hmm.
a real luxury. And the TV's $300 and there's 2% deflation. So your choices are you can buy the TV today for $300 or you can wait a year and save yourself $6 and buy it for $294. Are you going to wait a year? No.
No chance.
You're going to buy it today. Exactly. So anyways, it's preposterous economic doctrine.
Well, I would also imagine. I'm sorry. I would also just imagine, and I think it's a big problem that exists in today's market, is that people feel like no matter how much you save, you can't keep up with the cost of like the amount that you're going to save over the course of a year or two or three can't possibly keep up with the amount of that the prices are going to keep on rising over the course of 2 or 3 years. So like, why even bother? I mean, I could tell you even about, my own experience buying homes, like it is crazy, and people don't, and it used to be that I imagine at least, I don't know what, and I'm sure there's a lot of many factors involved in this, but you used to be able to save up. My dad told me before I bought my house, I was asking whether it was a good idea. And he said, I don't know. I said, what do you mean? He said, at the time when I bought my house, in 1994, he was like, I bought a $250,000 house. I was making $85,000 a year. And I spent approximately a third of my salary knowing that I'll be able to cover it. He's like, nowadays, if you make $100,000 a year, and you're buying an $800,000 house or a $700,000 house, I don't know whether that's considered a good deal or not, and whether it's going to be worth more in a couple of years or not is almost irrelevant. Like, how you have to be able to keep up with your bills right now, So, I feel like it's discouraging people from spending even more. No?
No, absolutely. And again, I have two chapters in my book on housing and
Mm-hmm.
explaining why house prices going up should not be happening. And again, it goes back to the difference between capital and money and how a free market system is supposed to work. So let me backtrack a little bit, and then I'll get right into housing,
Sure.
and your listeners will understand, but your younger listeners in particular, how they're getting screwed, and how my generation is benefiting at your generation's expense or at younger people.
Mm-hmm. Sure.
So in a free market system, you should only benefit to the extent that somebody else is benefiting from your actions. So the example I like to use is, let's say you make a bike and I make a suit. So we've both created capital, right? The creation of capital in the form of a good or a service, that is what makes the world go around. People investing their time and efforts and ingenuity to create capital
Mm-hmm.
that they think other people would want, and then they exchange that capital with each other. So then you make your bike, I make a suit, we exchange that with each other. No, I've got your bike, you got my suit. And importantly, none of this came at anybody else's expense.
Right.
There was no bike and no suit in the economy. Now there's one of each, and we exchanged it. If we
Mm-hmm.
do it, exchange it with each other, it's called direct exchange or barter. You can't have an economy with direct exchange barter. Like once you get past you know 10 goods or something, it just doesn't work. Like, yeah, how many kitchen chairs would it cost to take a flight to Florida? That sort of thing.
Right.
So we don't do direct exchange. We do indirect exchange, and we use money. So money is what's called the medium of exchange. We use money to exchange all the capital that we are all creating. That's all money is there for. Well, it's a store value, unit of account, stuff like that. But that's essentially what it's there for, to exchange all the good stuff that we're creating. So if you increase the amount of money, you haven't increased the amount of stuff.
Right.
All that happens is the prices that stuff gets exchanged at goes up because there's more money.
Right.
So now, let's say you make 10 bikes, $1,000 each. You sell them for $1,000, so you've got $10,000 now in your bank account. That $10,000 effectively, what it's doing is temporarily storing those 10 bikes that you made. That's
Mm-hmm.
where that value for that $10,000, it's the 10 bikes that you created. When you go out and spend that $10,000, what gave you the wherewithal to go and buy something else is that you made 10 bikes. You created capital.
Mm-hmm.
And so when you look at whatever your material wealth is, house, car, clothes, whatever, that's supposed to be a reflection of material wealth cumulatively that's out there that other people have because of
Right.
your efforts. It didn't come at anybody else's expense. Now we're moving away from that, and I'll get into that in a second. So let's say you've got your $10,000 in your bank account and you don't want to spend it yet. You're going to save it and at the end of the year, go on a nice vacation. But before you get to spend your $10,000, the central bank doubles the money supply. Now, when they double the money supply, what they do is they print the money out of thin air. They don't create any capital to obtain that money. So that
But
money
can
has
they? Is there a way to? Is there a way to?
a way to.
To create the cap? Meaning, can they say we're gonna? Can we want to do a construction job, and so we need people to do the work, or something like that?
Yeah, but to pay the people to do the construction work, they have to take capital from the private sector.
Right. Okay. Fine. Gotcha. Okay.
So good question.
Okay.
So when they print, the central bank prints money, it just prints it out of thin air, presses a few
Mm-hmm.
buttons. So that new money has no capital stored up in it. But it obtains capital as soon as that money comes into the economy. And it obtains capital by taking capital from the rest of the money that's already in existence.
Correct.
So as soon as they double the money supply, that new money takes 5 bikes from your $10,000 and puts it in new money. And
Mm-hmm.
so on your bank account, it still says that you have $10,000 in your bank account. But now it's only storing 5 bytes instead of 10. And so your $10,000 will now only buy half as much as it would have done before the
Mm-hmm.
central bank, the money supply. So that's how they take your capital from you. Government can take your capital from you in three ways: taxation, borrowing, you can lend them your capital, or they print money and take capital from the money that you already have. There's no other way for the government to get capital. That's it.
Mm-hmm.
So, we should not be benefiting at somebody else's expense. We should all be creating capital and fairly exchanging it. But what's happening in this world because of monetary policy, which deliberately drives asset prices higher, it does so at the expense of the general economy. And so what
Right.
you have is, it's becoming, there's still a lot of great things going on in the economy. But again, it's that which isn't seen. There's a lot less of it than there should be, which is why debt's going through the roof. Productivity growth has declined over the decades. It's moving towards like a game of poker. Now, at a game of poker, at the table, there's no net wealth creation. It's not that everybody walks away from the table a winner. It's a redistribution of wealth at the poker table.
Mm-hmm.
Right? So increasingly we are moving to a redistribution of wealth in the economy rather than a creation of wealth. And so in a poker game, what you end up with is one winner and a bunch of losers, which is increasingly what the real economy now is starting to feel like for so many people. They see
Sure.
the top 1%, top 10% making out like bandits, and life is really tough for everybody else, particularly for the bottom 50%, who are far more hurt by inflation than higher income people.
Sure.
So, back to housing.
Yeah.
So, nobody should be making money on their home. A home, if you have a mortgage, is like a form of forced savings. So, you have to pay the bank back. And every time you do, you pay some principal and you pay some interest. And every
Right.
time you pay some of the principal, it's like forced savings. So, you're putting money into your home.
And to clarify, clarify for people that don't know, principal is the amount that I borrowed, and then the interest is the percentage that they're charging me to borrow that money. So if I took out a $300,000 mortgage or a $100,000 mortgage, that would be the principal, and then if it's at 3% interest, then I pay a partial amount of the total amount that I borrowed from the bank, and then X% of the interest that I'm paying on it as well, right?
Exactly.
Okay, yeah,
Thanks for clarifying that.
sure.
And so then over the life of your mortgage, if you have a 30-year mortgage, 30 years later, you've paid it off and you don't owe the bank any money. And so if you bought a home for $300,000, now you have a $300,000 home.
Mm-hmm.
That's your home equity, and you can use that for your retirement. But today, central bankers will encourage people to extract the equity from their home. So once you've paid part of your mortgage down, they want you to borrow on that.
Mm-hmm.
Excuse me, and go and spend it. So because when you spend, it's somebody else's income, and so they never pay the mortgage down, and you have older people who still got a lot of debt on their home, which is crazy.
Oh yeah.
And effectively, what people were doing, especially in the boom of 06, 05, 06, people were effectively consuming their homes by extracting equity from it and buying a big SUV, another big flat screen TV, whatever, more expensive trip. But back to housing and why nobody should be making money on their home. So, our home, we live in Mississauga, which is a suburb of Toronto, and we bought our home in 2001, just when the central bank, the Federal Reserve, started what's called their wealth effect monetary policy, targeting asset prices to drive them higher to try and drag the economy up with it. It doesn't work. We can go through.
Of course not.
So our house over the last 24 years has gone up in price 4 times. So what was our contribution to society that justifies my wife and I making 4 times on our home? Let me help you. It was zero. We did nothing. And so if we did not do something to warrant making four times on our home, then our benefit must come at somebody else's expense. There is no
Can
free
I ask?
lunch. Yeah, go ahead.
I'm so sorry. Can you make the argument perhaps that that it's based on just the demand for people wanting to live in a beautiful suburb near Toronto, and there's only a limited amount of homes, and so the reason why your home value went up isn't because you contributed necessarily, but because other people want to live where you live and they can't?
Yeah. So, and yeah, it's a good point. And for like big cities like New York or London, England, or whatever, that's definitely true. And that you know it's going to attract people. There's only so much space. Although New York, they start building up, right? But it's more expensive. But in suburbs, it should result in increased supply of homes.
Okay.
Now, the supply in the housing industry, there's a term in economics, it's called elasticity and inelasticity. So the supply of homes is less elastic. What that means is if demand goes up, yes, supply of homes will adjust, but it doesn't adjust overnight. You got to get permitting. It takes time but it does happen.
Hmm.
And for years, for decades, it did happen. That house prices, yeah, they grew a little bit faster than inflation, but not much.
Right.
In Canada, from 1970, I think it was, or 75 to 2000 or 2001, the average price to after-tax income ranged from 6 to 8, so it was like 7 times.
Wow.
As soon as the Federal Reserve wealth effect policy starting in 2001, first with Greenspan and then Bernanke, and he took it on steroids, prices just continued to soar. And so we went from an average of 7 times price to after-tax income, and we're now at 12. And that's why young people in Canada many of them can't even dream of ever owning a home and raising a family.
Hmm.
This is a moral crime, I think. So a house is not a productive asset. So our house went up 4 times in price, not because all of a sudden it started producing 4 times as much stuff, not because it grew 4 times in size, not because it relocated maybe down to where you are in Florida and oceanfront view.
Hmm.
No, it's the same economic good
Right.
that a younger couple or a newcomer to our country has to pay 4 times for what we pay for it. And so it's a
Hmm.
redistribution of wealth. There was no wealth creation
Uh-huh.
in society, right? So you made your suit, I made my bike, there was none, then there's one of each. But when I make 4 times on my home, it's not like 4 more homes were created. There's no more capital. It's still one home.
Yeah.
Redistribution of wealth from the younger couple's bank account into our bank account. Still the same amount of capital.
Right.
And, I haven't done anything wrong. People my generation, none of us have done anything wrong. We've played by all the rules. And housing prices always go up, and that's what we're told. And so you want to get in on the housing ladder, all this ridiculous terminology. But people, and I get it. There's no bad people here. It's just a bad system.
Hmm.
That central banks, see, when you have a wealth effect through stock markets, so if stock markets are rising because companies are putting capital to productive use and creating more capital, growing their sales, growing their profitability, hiring more people, paying them more,
Hmm.
everybody's winning. Stock markets go up to reflect the fact that more capital is being produced in the economy. That's
Right.
a really good thing. That's a real wealth effect, real wealth being created, and the world is better off.
And the shareholders benefit too.
Shareholders benefit, employees benefit, society benefits, suppliers, everybody benefits, right? That's the way it's supposed to be. There are 6 constituents to a business. So shareholders, senior execs, employees, suppliers, society at large, and then the consumer.
Hmm.
Consumer or customer. customer is number one, right? Because of all these six, the customer is the only one that pays.
Right.
Right? But it's important that all of them are benefiting from this business model, right? So so that's all really good. That's a really good true wealth effect. And so what you want to do as the central bank, you would want to establish the conditions that would allow for the most capital to be produced and then fairly exchanged through a medium of exchange, money that can be trusted. But the central banks decided they couldn't wait for all that stuff to happen, for all the productivity stuff to drive stock prices higher. So instead, they decided to drive stock prices higher themselves and hope that that would drag the economy up with it, drive asset prices higher. And yes, the top 1% and top 10% will inordinately benefit from this, and they do. But their belief, policymakers' belief, I think, was that the benefits of all that would trickle down to everybody else over time. Well, spoiler alert, they haven't,
It
and
doesn't.
they
Right.
won't.
Right.
And theory will tell you that, and empirically, that is also what has happened.
Right.
So they drove interest rates first to zero to drive the valuations of stocks higher, and then they drove at the same time making. They said, well, we're taking mortgage rates. They started buying mortgage-backed securities to drive mortgage rates to ridiculously low levels. They said, well,
Right.
we're doing this to make housing more affordable. No, you're not making housing more affordable. You're making mortgage payments more affordable in a short time by driving interest rates down. But what happens is it results in an explosion of demand for housing,
Right.
and so housing prices go through the roof. And so when people later on are buying a house, their mortgage payments are no longer affordable.
Yeah.
And this is where we are today. So,
Anecdotally, by the way, anecdotally, with I owned a townhouse before I bought my house now, and I bought my townhouse in I think 2021 for about $300,000, and then for a while, and this was I think 2021, and there's before it was a big bump. I think borrowing was still at 2 or 3%, and then and within a year or two, it went up to like an agent knocked on my door and said you could sell your house for 415. I was like, I'll do that. And the next day, interest rates went up, and I could not get a single offer. And I ended up, I think, selling for like 375 or something like that. But it just shows, like, just to bring your point to life, like, just because interest rates are low does not necessarily mean that it makes it cheaper in the long run by any means.
exactly. And, the trouble with all of this, I mean, not only have you priced a whole generation pretty much out of the housing market. I mean, I'm sure you've seen the stats of the average age of the first-time home buyer in the States is
Yeah.
way older now than it was back in the day. And there are certain societal things that have changed over time as well that will contribute to that, to be fair.
Expectations for sure.
Pardon?
Expectations, I'm sure. My grandfather lived in a three-bedroom, one and a half bathroom with five people in the house, and no one want. I mean, I wouldn't buy that if I knew that I was going to have three kids. I don't want a one and a half. I don't want everyone to share one shower. So
Oh, of
that
course, of
standards change
course.
too.
Yeah, of course. And
Yeah.
no, so, but the bad news. So there's two things. First, the younger generation being priced out of the housing market. But to fix it, you have to let interest rates and mortgage rates be determined naturally by market forces rather than dictate.
How would that work?
So just if the central banks stopped deciding on interest rates, and they do, I mean, they affect the short-term interest rate, but the short-term interest rate also has an influence on the longer-term interest rate. And then when it doesn't, they will start what's called quantitative easing. They print money to buy longer-dated bonds and mortgage-backed securities to drive those interest rates down.
Right.
And so there's what's called, actually, before I get on to natural interest rates, now determined, just let me finish my thought on the negative impact of this.
Yes.
So first, the younger people not priced out of the market. And then for people, particularly younger people who have bought a house in the last 5 years or so, the only way to fix this is for interest rates to be naturally determined and stop driving them to zero, and for prices of houses to descend to their long-term average of price to income, which would be, again, determined by market forces. But the problem for people who have bought over the last 5 years is that they'll end up being significantly underwater on their mortgage. They would have like negative equity, that the mortgage would be worth more than the house. And then people feeling that they can't move because they can't take that loss. And this is a terrible thing,
Mm-hmm.
right? But it should not be prevented from happening. And because, so these are your choices: save the equity in people's homes today, or allow the next generation to dream about buying a house one day and raising a family.
Yeah.
And the equity, like for me, that I've made in my home, as I said, I've made it unfairly. And so I'd be very happy to see the price of my house go back to what it was when we bought it, in inflation adjusted terms, of course. Because then
Mm-hmm.
that would mean that housing is becoming more affordable for people.
Right.
And the money I made at somebody else's expense. Now, we're going to give that money to I have 3 daughters. So
Mm-hmm.
we'll give that money to them so they can afford to buy an overpriced home, But we're between a rock and a hard place. There is no easy way out of this quagmire. But this is what happens when you interfere with the market. All good intentions. I don't think there was a conspiracy here. I believe that central banks, primarily through arrogance, they thought they knew better. And they thought they could take credit for doing this, and they love the adoration that they get from Wall Street, and everybody's
Mm-hmm.
happy. Driving stock market's higher and housing prices higher. Everybody loves them. But now we are in this unholy mess of which there is no easy way out. And so what they will probably do is inflate their way out. They'll tell you that inflation is a lot lower than it really is. It's called financial repression, is a term that they use. And they financially repress the populace. And so your money will be debased, and the value of your money will erode over time, your savings. And to your point, then people start to feel, well, what's the point in saving?
Mm-hmm.
Inflation is so high that my money is going to be worth less in the future. I'll spend it today. And policymakers actually like that, because if you spend your money today, that makes GDP look stronger, because all GDP is a measure of final spending.
Mm-hmm.
Final spending, 75% of it or 70% of it is consumption. But the more you consume, the more an economy consumes today, instead of investing, the less stuff that will be produced in the future. And there's no ifs, ands, or buts about this. This is
The
not up for
less
debate.
the less that
So,
we consume. Say that again. I'm
so,
sorry.
so,
Yeah.
yeah. So the more that you consume, spend today,
Mm-hmm. Yeah.
and the less that you save and invest,
Mm-hmm.
the less stuff that can be produced in the future because there was less investment.
Right.
So if society is consuming more rather than saving more, then that consumption results in a higher GDP number at the expense of a lower GDP number in the future.
Right. Long term. Right.
GDP, because policymakers, they focus on GDP, which is a symptom. It's not a fundamental. GDP is just final spending. So if final spending is growing, consumption is growing. Let's say your consumption is growing because you got a fantastic job and you're creating all this capital and fairly exchanging it with others. So your GDP, your final consumption is growing because you're creating more capital that's allowing you to spend.
Mm-hmm.
But if your spending is growing because you're saving less and borrowing money to consume, so if your GDP is a result of you taking on more and more debt, then your spending, your GDP, is not going to be sustainable. Eventually, you're not going to be able to service any more debt. And that's what's happening in the economy. The U.S. debt is going through the roof. I think over 120% debt to GDP now, I think it is.
It's it's so concerning, and what at least to me, and perhaps you could I guess confirm or confirm this or not, is that it feels like we just keep on building on, like finding new ways to create more debt to push off the consequences. So first you had student loan, medical debt, credit card debt, buy now pay later models that are going on right now that have nothing to do with your credit score or anything like that, which is crazy. you got auto debt, you got your mortgage. It feels like the entire American economy is just kicking the can down the line until we figure out a way to either start paying off the debt or just collapse under it, you know?
Yeah, yeah. Well, it'll be the latter. Um, no, it will.
What do you do?
But well, the reason I wrote my book, um, which is called Capital Offence, Why Some Benefit at Your Expense, because they take your capital every time they print money, like I explained earlier.
Hmm.
The reason I wrote the book, and I wrote it in very easy to understand terms. I wrote it for people who are not in the finance industry, who are not investors, who are have not studied economics. And I use analogies and stories. And if you read it, you will understand how an economy works and how it doesn't, and the difference between good inflation and bad deflation, and what really causes inflation, all that kind of stuff. And the reason I wrote it in this way is because I think that the average person is very, very smart, particularly when it comes down to what to do with their own hard-earned capital. They don't need policymakers or central bankers to tell them that this price is fair, or you shouldn't be buying this, or you shouldn't be saving as much. You should be. No, they don't need anybody telling them. They know what
Right.
to do. And so once you have uh, an empowered citizenry who really understands what's going on, you arm them with the truth. Then they can demand from our policymakers better actions, better decision making. And our policymakers will make those better decisions, but they'll only do it once we demand it from them. And for years, decades, we've been demanding something else. They have convinced us, and they've been convinced by economists and people in academia with fallacious, ideologically driven economic doctrine, that you can have your cake and eat it too, that you can get something for nothing. You cannot. If you get something without contributing, it comes at somebody else's expense. So once people, so policymakers are good people. They just
Hmm.
they want to believe in the easy way out, the popular way out. But the popular
Right.
way out is what leads to terrible consequences for the rest of us down the road. But it's hard for people to connect the dots between these popular, fun, nice decisions that gave us all kinds of stuff years ago to now we're screwed.
Right.
And a perfect example is back in 1983 in France, President Francois Mitterrand, he lowered the retirement age from 65 to 60. And so, oh, he loves us. What a nice guy. He wants us all to retire 5 years earlier. Well, I want you to retire at 30. That makes me even nicer. Only it doesn't come at somebody else's expense, right? And
Mhm.
now there's the pension plan is in huge trouble, and the liability is foisted onto the generation that's following them. So all these people are retiring earlier at the expense of the next generation. And so, there's a saying that the people always get the government that they deserve.
Yeah.
In other words, well, you voted them in, so stop complaining. But you can only get the government you deserve if
If
you
you're
know what's
educated.
going on.
Yeah.
If you know what's going on. If you don't know what's going on, if they tell you that, yeah, will just take on more debt and we'll drive stock prices higher and housing prices higher, and then the benefits will trickle down to everybody else, and we're all gonna, make a fortune, rainbows and buttercups as far as the eye can see. You're gonna believe in that, then you're gonna vote for that. But
I bet
if you,
do you run into the same problem when it comes to minimum wage? If people just arbitrarily choose a minimum wage, $20 an hour, $15 an hour, and you say, you know what, let's say minimum wage was $12 an hour. I'm going to decide now that minimum wage in America is going to be $25 an hour. That's essentially the same thing, right? I mean, you're forcing people to get paid more, even though they haven't really created more capital or done anything more to create more capital, right?
yeah, no, exactly, and the issue is not, I don't think, minimum wage.
Okay.
And I think the issue is the prices that people have to pay with their minimum wage, either for food,
Mm-hmm.
gas, or health care insurance, or rent, or
Yeah.
house prices. I mean, everybody wants people to make more money, but it comes at somebody else's expense.
Mm-hmm.
And, I mean, it's not, people don't like the laws of economics sometimes because they can be very inconvenient, but they are what they are. And so, in writing my book, you know, again, I'm not an economist. I've studied economics for the last, I don't know, 17 years. That's all I read: economic philosophy and monetary policy and stuff like that. But the laws of economics can be very inconvenient. And so, when people don't like the laws of economics, they make up their own. It's called normative economics. It's based on
It's a very nice
ideology.
name for
It's
that.
based on it's based on ideology in the way they would want things to be rather than how they are.
Mm-hmm.
And it makes them more popular, especially with politicians.
Right.
And some economists have likened it to getting angry at the law of gravity and blaming the law of gravity for plane crashes.
Mm-hmm.
Stupid gravity. No, it's just the law of gravity. Don't get angry at gravity. Get angry at the pilot or the manufacturer or whatever.
Sure.
And so there's no easy way out. But I believe that, again, people are very smart, and I think most people want to do the right thing. Most people like to help people, and so, but like we were talking about before we started recording, the issues transcend politics.
Mm-hmm.
So people know that they're getting screwed, but they don't know how. And
Right.
then we always, if we're getting screwed, we want to be able to blame somebody because it's not our fault. It's not
Right.
young people's fault. So who's to blame for this? And so if you don't understand what's going on, then it's very natural for Republicans to then blame Democrats and Democrats to blame Republicans. And
Even though in
I
terms
have
of
no,
policies, it's had the same consequences over the last 25 years.
yeah, no, exactly. It doesn't matter who's in power, right?
Yeah.
So I know beautiful people who are Republicans and who are Democrats, and for the most part, they believe in exactly the same kind of stuff,
Right.
But then, if one says a Republican and a Democrat, all of a sudden they hate each other.
Mm-hmm.
It's crazy. It's so sad what's going on.
Yeah.
And but I think that with a better understanding of truth, and it's a lot easier to be compassionate.
Mm-hmm.
And that for younger people who've recently bought a home, and if home prices go down and they sell at a loss, there could be some sort of taxpayer benefit to help them out partially,
Sure.
at least. Is particularly if that benefit is coming from those who made a fortune on their homes.
Right.
Who, I mean, I know, and people my age, most people my age, when I tell them this thing about housing, first they're kind of shocked, but then they get it, and they said, "Yeah, honestly, I never even thought about it. You're right." But every now and then, I run across somebody who doesn't like it, and they like to think that they made a fortune on their home because they timed the purchase just right, or somehow they deserve it, and they'll throw all kinds of stuff at me to try and justify and rationalize why they're making money in their home, and it doesn't come at somebody else's expense. And I understand. I mean, they're few and far between, by the way. Most people get it.
Mm-hmm.
But it's not a pleasant thing to hear, because for years you've thought, hey, I know what I'm doing in housing, good for me. And then I come along and say, well, no, not so fast, And and I think particularly in America, you guys have such a can-do spirit, the patriotism, when you're all facing something together, you all come together and will want to do the right thing, but importantly, people have to believe that we are all in this together. That it's not just me that's going to be making the sacrifice. It's not just me the one that's going to get screwed.
Hmm.
Yes, the leaders, my boss, everybody, we're all going to, we're going to struggle a little bit for a few years maybe, make some sacrifices. But coming out the other end, things are going to be fantastic. And it's going to be a much fairer redistribution of the capital that we're all creating. And if people believe that that's the end game, I think people will agree to do what's necessary, and then the leaders will come to the fore to make those kind of decisions. I
Hmm.
really believe that. And well, the alternative is that we continue on this current unsustainable path, and rather than a controlled implosion, like when you blow up a building and it all comes down, it doesn't is an out of control explosion with
Hmm.
significant collateral damage. Even worse is that we could get a significant change to our economic and political system, which at first would appear to be a good thing because there would be a much fairer redistribution of wealth, like through socialism. But there would be far lower wealth being created, and
Sure.
the world would be significantly poorer and ultimately angrier at each other because of
Right.
what's happening.
Right. So I have a couple of follow-up questions. But it seems that a lot of the issues are a consequence of policy in order to make short-term gains. And right. And I also noticed that it feels like, especially with corporate companies, there's enormous pressure, especially ones that have to answer to stockholders and have stockholders. The quarterly earnings forces them to try to create these short-term wealth, well, decisions to create wealth as opposed to long-term company success, right? Because and Amazon was a notorious case of a company that didn't care about its valuation, I guess, or what its short term. They said we have a big picture in mind, and for a couple of years, they didn't mind what the stock price was. I believe I could be wrong. I believe I recall reading that, and they were able to keep their eye on the long game, and they are what they are now.
Yeah.
But so, do you think that it would change? Like, I think I heard Trump float the idea of changing quarterly earnings to half a year earnings or something like that. Do you think that would make an impact?
It would help for sure. Um, and my investment style and my investment team, we were very long-term shareholders, long-term investors. And so when we were meeting with a company, the company would often start talking about what they were going to do the next quarter, what sales would be, what the profit margin would be the next quarter. We said, we don't care.
Right.
We want to know what your sales growth and profit growth will be over the next 10 years,
Hmm.
and how are you going to do it? How much are you investing in the business? What are you investing in? What gives you confidence that you're going to win this game? What are the biggest threats that you have longer term, either from competition or regulatory issues from policymakers and stuff like that? And if the stock market or analysts and whatnot focus more on the long term, then it would change the behavior of companies, and they would focus on longer term rather than on a short term share price. So companies, if they're expected to hit a certain profit margin over the next 3 months or 6 months, they might start under investing in their business to save money to make their profitability higher, but then that comes at the expense of sales growth in the future.
Right.
Or, they want to drive their stock price higher, so companies will, if you have your own company and you take on debt to start your company, one of the first things you want to do is pay down the debt
Hmm.
and stop sharing, the profitability with the banks by paying them interest on your debt. And plus, you want that confidence that if things change, you're not going to have too much debt and go broke. But then, in stock markets, companies are rewarded for taking on debt because the market sees that the company is going to take on debt to buy back their shares and drive their share price higher. Then the executives then cash in on all their options. And I use a couple of examples in my book, or at least one.
Okay. Can
General Electric.
you want to give a couple of them, or one or two
Yeah,
examples?
yeah. So General Electric took on billions, tens of billions of dollars in the mid 2000s of debt to buy back their shares. So they're buying back millions of shares every year, and this was driving their share price higher.
Hmm.
And so every year, executives were cashing in millions of dollars worth of options. But they were driving the share price higher, not because they were creating more capital, and the capital was growing and driving the share price higher, because they were taking on debt to buy back shares and reducing the amount of shares in the market and driving the share price higher. And then they got into trouble, and because they had so much debt, and they were having to start selling off parts of the business just to survive.
Right.
This is really bad corporate culture, and it's similar to what policymakers do. So when you have company management who, rather than taking on debt to invest in the business and create more capital, they drive their share price higher by buying back shares. Similarly, policymakers will encourage GDP growth through debt rather than establishing the conditions for the efficient allocation of capital in the economy to create more capital to drive GDP higher.
And
So I
what
think
would
you've
be
got the same.
tangible ways to do that? What are some tangible ways
Pardon?
to, what would be some tangible or actionable ways? Like if that was implemented tomorrow in the States, what would that look like?
Well, the first thing, they'd stop manipulating interest rates. So the most efficient capital allocation in an economy is driven by what's called the natural rate of interest. Very different from the neutral rate of interest. And these two often get conflated, but they're very different things. So the
Okay.
natural rate of interest is determined by market players in the economy who have their own skin in the game, their own capital. So individuals, corporations, banks, and we're all making a risk return assessment about what to do with my capital. So if I'm going to lend my capital, or you're going to lend capital to me, you're going to have to make an assessment with respect to what kind of risk I am. Am I
Hmm.
going to pay you back the money, or am I going to be gone? And
Right.
so if I'm a higher risk, you want a higher interest rate. If I'm a lower risk, then a lower
Oh,
interest rate. And
right.
so you get millions of people and corporations, organizations, banks making all these decisions on a daily basis. And what results is what's called the natural rate of interest. And this results in the most efficient allocation, the most productive economy. But what central banks focus on is the neutral rate of interest, which is the rate of interest that allows for consumption, spending, and steady growth in the economy without resulting in inflation. And so they start taking interest rates down to encourage consumption and get GDP growing. And when they take interest rates down, what happens is people take on more debt to drive the
Hmm.
economy. So it's debt fueled consumption, debt fueled
Right.
spending. And so it looks like it worked. Well, we lowered the rate to get to that neutral rate to get the economy growing without inflation happening. But then, because people took on debt, they're servicing more debt. Eventually, their spending starts to flatline because they can't take on any more debt. And so, it sounds about, we have to lower the neutral rate again to get
Hmm.
so people take on more debt, so their spending picks up, and then it flatlines again. We have to say, and they're all mesmerized. They're astonished that the neutral rate of interest, for some reason, over the last number of decades, has kept grinding lower. And then they blame it on global secular stagnation or something like this. No, it's because you're taking the neutral rate, further and further below the natural rate. The natural
Right.
rate that results in the most productive economy is up here.
Wow.
You've got interest rates down here so people can take on more and more debt to drive GDP higher.
Right.
And so the further you go down here, the worse things get.
And
And that's
debt
the
and debt
central
means long term lower GDP, less spending long term because people have less money, they're more
bank.
focused on paying it back.
Exactly.
Wow.
And
Wow.
and so there, I have a quote in my book from Ludwig von Mises. He was considered the king of the Austrian school of economics. Brilliant. And he had a saying where he said that policy. So here's the natural rate, right? Neutral rate down here. He said policymakers can deny you the right to receive the natural rate of interest. Right? They drive it down here. You're getting this.
Right.
They can deny you the right to receive the natural rate of interest, but they cannot eliminate its existence. The natural rate, i.e., the most productive rate, is still up here. They're just denying you from getting it,
Yeah.
and with the resulting consequences that that has for the economy at large.
So abolish the Fed. I'm just
No,
kidding.
I
I'm just
wouldn't.
kidding. I'm just kidding. I just
No, listen. Like, the starting point matters,
okay.
and I don't believe that the Fed are bad people. They have a mandate, right, which comes from Congress, and Congress can change this mandate anytime they want, right? People say
Presumably,
the
sure.
Fed's independent from the. No, they're not. And I think McChesney Martin, he was a famous Fed chairman from the through the 50s and 60s.
Hmm.
He said something like, it was on a Free to Choose Milton Friedman documentary. I think he said that the Federal Reserve is independent, uh, not independent from government, but independent within it, or something like that, something cryptic like that. But the bottom line is they're not independent.
They're definitely not.
They're not. But so I wouldn't abolish the Fed. No, I would have. It would have been better if the Fed had never been created in the first place back in 1913, I think it was. But it is here, so I think if we just had a more responsible Federal Reserve, who would be able to resist pressure from the government to increase the money supply. But the problem is, if you did have that sort of Federal Reserve, then Congress would probably just change its mandate and change the people who were in charge. So you need
Right.
Congress on board as well.
Hmm.
And so if you have Congress on board and then the right people at the Fed and just have a more responsible approach to monetary policy and stop driving the money supply so high so quickly, that will go a long way to fixing things. Another way would be, well, stop bailing out Wall Street, right? So
Yes.
stop stop privatizing the profits and socializing the losses. That would go a long way if Wall Street and financial markets knew that the central bank would not come to their rescue with zero interest rates and or quantitative easing. It would
Hmm.
significantly change the behavior of market players.
Right.
But they're doing the rational thing because they know that the central bank will come to the rescue, even though it comes at the cost of Main Street, of the general economy, because the Federal Reserve has sacrificed the Main Street economy on the altar of higher asset prices, and the market players know this. So you get that out of the moral hazard, you get that out of the picture, things would be much better. And then this belief that I'm not anti-government. Government's very important, and there are a lot of great, hardworking people in government, but too much government is a really bad thing. And government keeps growing, and because it can only obtain capital by taking it from the private sector,
Hmm.
the more it takes, the more, and government spending is consumption. Very small part of it is investment. So the larger government becomes, the more consumption that happens rather than investment, and the poorer society becomes. And the
Right.
government starts becoming this entity of itself, and it's got its own survival at stake and in mind. And again, bad systems bringing out the worst in good people. And so you need smaller government. I'm not anti-welfare. I like the fact that we can help people, or employment insurance or medical insurance or whatever, help people who can't help themselves. I mean, that's really important, and it feels really great to do
Hmm.
within reason,
Sure.
right? Within reason, because it all comes. There's no such thing as government benefits. They're all taxpayer benefits.
Right.
Taxpayers are the ones who pay for all of those things. So we should get that terminology out of lexicon or whatever. it's not government benefits, it's not government subsidies. They're
Yes.
just channeling money from the private sector, from one part of the private sector to the other part of the private sector, and reduce red tape, bureaucracy. You know, doesn't mean there shouldn't be rules, doesn't mean there shouldn't be regulations, but within reason. Regulations should not be there to justify jobs, to justify careers in government.
Right.
And yeah, so it's not going to be easy, right? But I think just this understanding and acknowledgement with respect to how things really work and how they don't, and who's suffering and who's benefiting somebody else's expense. That's I think that would be a good starting point.
Right. 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 Man, you give me a lot to process over here. A lot to think about. Um, and what happens, I guess, worst case scenario?
Well, uh,
Like worst case scenario is that we just keep on doing exactly what we're doing, and then it like collapses. Like what does it look like when we have too much debt and then we just don't have enough money to pay it back? What does that look? What happens then?
yeah. So what happens is the most likely path that the government will take is what I mentioned earlier. It's called financial repression, and so you will be repressed financially. So the so they have so much debt outstanding that the only way, I mean, they can't pay it back by
Hmm.
raising taxes, and eventually, and a lot of the debt is held by people outside of the country, and so people start to get nervous that the U.S. is not going to be able to pay back the debt, and it's not just the U.S.; it's all developed
I think
economies.
our debt has downgraded, right? Has been downgraded the last couple of years.
Yeah, marginally. I mean, if it's a corporation, it'd be like a junk credit rating,
Right. Right.
But but the U.S. people will say that, well, the U.S. can't ever default on their debt, and technically that's true because they can just print money.
But
So if they're going to
there's
print,
no capital backing it.
no, exactly. So if they just print money to pay you back the debt that you lent them, then yes, you'll get 100 cents on the dollar, but those 100 cents are only going to be worth half as much as they were when you lent them the money.
Right. Right.
So
Right.
they've taken your capital from the money before they give it back to you, and you're poorer. And so that's the accepted. A lot of people, it drives me nuts. A lot of people out there, oh, we'll just revert to financial repression. It worked after World War II and all this kind of stuff. And look how the government cut spending and we got debt to GDP down significantly after World War II. Well, the situation today is completely different from World War II. The government spending during the war obviously went through the roof because they were building tanks and planes and guns and ships. And after the war, the government just stopped.
Well,
Completely
we
stopped.
didn't stop. We just changed where it was going. It wasn't going for American armies. It was going for other armies.
Well, yeah, well, in late 40s, government spending plummeted because they didn't need to create all this war materiel.
Hmm.
And so in the late 40s, the government was running a budget surplus,
Right.
and debt to GDP fell significantly because also at the same time, they lowered interest rates from very high levels, and the private sector productivity exploded in
Right.
the late 40s. And then it sort of flatlined almost in the 50s because tax rates went back up again, as I mentioned earlier, to over 90%.
Yeah. Yeah.
I think there were four recessions in the 1950s. So people look at the 1950s as this glorious heyday of economic prosperity. It wasn't really. Late 40s was, and the 60s were. And it happened in the 60s because Kennedy was the one who first started lowering interest rates in the early 60s. And yeah, got off track. I can't remember how we
It-
got onto
That's
this.
okay. So I wanted to ask then, if that's the case, because the World War II example is a great example. Remember the movie Charlie Wilson's War with Tom Hanks? You ever
I
watched
didn't see
that?
it.
Yeah, it's about how Tom Hanks plays the congressman Charlie Wilson that realized that the United States could fund the Afghans in their war against the USSR,
Oh, I did see that. I did see that.
right?
Yeah.
And he basically just ended up, they had like a $2 million budget. He ended, and he ran like this Black Ops congressional, committee, and basically just had the reins to the purse, and they just started spending like crazy. Right now, on one hand, the emphasis of the movie was, what we did, that we basically funded a quote unquote secret war, but what the movie doesn't talk about would be the potential economic consequences of taking, 250, 500, $1 billion, whatever it is, and giving it to the Afghans, or let's say even moving it to the private sector to create weapons to give to the Afghans, right? No one talks about the consequences of what that does to the American taxpayers. We talk about what it does over there in the Middle East, but it doesn't. We don't talk about what it does over here. Um, and that has a pretty astronomical impact on our economy, doesn't it?
Yeah, I'm sure it does. How much I don't know, and it's I'm not belittling it, but it's not sort of my focus in my book.
Okay.
There's enough things to be angry about. You know,
Well, yeah, yeah. I don't want to be. I
it
don't know if angry is the term, but I think to be
or
again,
frustrated, maybe
conscientious,
frustrated.
right, or conscientious as to. I think the problem, like what you said, is that it's coming from so many different like places and so many different strands. It's hard to even like nail down what the problem is. And I think, like you said, so many young people who are smart don't even know where to even start looking, and start learning about this stuff.
Yeah, and you know, the issue is that people believe that something can come from nothing. So when government is spending all this money, they never have to go and face directly the people that they're taking the money from.
Hmm.
And so it just feels like there's this endless stream of money that they obtain or capital they obtain through taxation or borrowing or and then they hear certain economists tell them, yeah, don't worry, deficits don't matter, debt doesn't matter, we can just print the money, and they don't think about the consequences. This is the problem.
Hmm.
And by the way, I think before 1942, there was no such thing as withholding tax. So you would earn your money, and at the end of the year, the government would tell you how much you owed them in taxes. So you
Hmm.
would get the gross amount of your productive efforts. You would get fairly compensated what you produce. So that was the gross amount. This is how much capital I produced, and somebody else out there has that now. And then the government come, okay, you owe us this much. But now, with withholding taxes, you just get the net amount.
Right.
You never see the gross amount.
Yeah.
And so you start to think, well, the net amount is what I earned. No, you actually earned way more than that, but the government took it,
Hmm.
right? So it's out of sight, out of mind. Something you never get your hands on it. It's less feels less painful. It was an ingenious thing that they did.
Well, I would also imagine, I know for myself, hypothetically, because it took me, I'm still working on my financial responsibility, right? I'm not the most responsible individual out there, with my $30 bottles of craft beer or whatever it is, but but I, I could imagine, and I actually know this from, experience, like, if got all my money gross, and then at the end of the year, the government said, "Hey, you owe me 20% or 15% of whatever you made," right? I
Yeah.
I bet a lot of people wouldn't have that. Like, wouldn't have that just lying around. I think that
Well, I think they would, because if you know what the consequences are of not having it, it
right.
tends to focus the mind, right? It's
Okay,
not that people aren't capable of it; they're not incentivized to,
I see.
right? I'm not saying we should go back to that. I'm just
Yeah, 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 yeah,
saying
yeah, yeah. It's very, yeah.
it makes it easier for governments, to just spend money on whatever their projects are because they don't actually see the people and don't have to go and ask them for it. It's just taken automatically, and yeah, so it's just a mindset issue. I think is the problem,
Yeah.
and It's going to take a lot to change it.
So what? So I guess, and then another other solution would be to start creating more capital, and to be actually, creating more goods and services, um, rather than just trying to get more money, trying to print more money and then distribute it. Because and
Oh, exactly. Printing more money harms the productive capacity of the economy. Natural rates, no bailouts for Wall Street, and less bureaucracy increases the amount of stuff that's produced in the economy. But those who are in control prefer the, the former route
yeah,
because then they're in power. And this is how you get elected by spending more money. And yeah, so that's the issue.
right, right. How long did it take you to write this book?
6 years.
6 years.
Because I was still working full time when I was writing it. I started
Hmm.
in January of 2019, actually down in Florida in our place in South Palm Beach there.
Hmm.
And but I could only write on vacations,
Right.
and sometimes I would go 5 months without even looking at it because it was just too busy.
Hmm.
And then in 2023, I decided to leave my employer. As I said before, I love my job, my company. But I just got so frustrated I wasn't able to finish the book.
Right.
And communication and whatnot really became my real passion. And I'd already started my weekly blog, which people can access on my website for free.
And we're going to put that notes up
Um,
on
oh, thank you.
the website up in the notes for sure.
Yeah, thank you. And yeah, and so that became my great passion. And I just needed more time to finish the book. So if I wasn't working full time, I would have finished it, a lot quicker, obviously. But it was a journey writing that book for sure as well. And you learn a lot by writing, by speaking, by
Hmm.
getting the thoughts out of your head and out there. You learn because, for me personally, anyways, when I'm just thinking about things in my head, I don't really challenge myself enough on my thoughts.
Right.
And I don't need to because nobody else knows what I'm thinking.
Right.
But if I'm going to put it on paper or send it out in my blog or put it in a book, all of a sudden
And
it's
be
there for the whole
justified.
world to see. I said, boy, I better make sure this is right. you
Hmm.
know. And so you do
Sure.
a bit more thinking about it. You challenge it. You stress test it. You do a bit more digging. Oh, actually, I was wrong. I never thought of that. But I don't force myself to think of things through as much as I should unless I get them out of my head and on paper or verbally.
And the way that you would structure, the way that you'd go about writing the book was that you had a list of topics that you thought were significant for everyday people to understand, and then each chapter would be an elaboration on that.
Yeah, so not really. Like I knew what theme I wanted to discuss and help people to understand,
Hmm.
in terms of the difference between capital and money. That's a big one,
Yeah.
and how an economy really works and how it doesn't. And then I just started, oh yeah, I better talk about government. So there's two, oh, I better talk about housing. Oh, I better talk about inflation. I've got two chapters on inflation. Oh, I better talk about corporate culture,
Hmm.
bad corporate culture, good corporate. Oh, I better talk about capital. And oh, yeah, now I have to talk about stock markets. What are they?
Yeah.
Like, why are they important? What's the good role the stock markets play?
Hmm.
So, again, easy to understand terms. And yeah, so there's nothing wrong with stock markets, right? There's just a lot wrong with what they have become
Right.
because of central bank interference and moral hazard and stuff like that. And yeah, so it just started to build. Because, oh God, you know, if because I really want the reader to understand, and if the reader reads the book, they will understand what's going on, and trying not to take anything for granted.
Right.
So when I was first making presentations when I was a professional investor, like 25 years ago, my main goal was to impress people with how smart I was.
Hmm.
And if I impressed them and they thought I was smart, then maybe they'd give me their money so I could manage the money. I could make money that way. And then, I wasn't being entirely honest or intellectually honest with people. I was trying to impress them. And then I got get caught up in like little white lies and stuff like that, or I'd leave out certain things that I knew that they would be interested in, but that might mean they wouldn't give me the money to manage. And so I just thought, I'm not doing it anymore. I am just going to tell the truth. There's a great saying I have in my book. I forget who said it, but if you tell the truth, you never have to worry about what you said.
Yeah.
You don't have to remember what you said, right?
That's
Because
a
you
great
told
line. It's a beautiful
you
line.
told the truth, and it's so it's so liberating. It just feels so good, and it's amazing the impact it has on people around you.
Mm-hmm. Sure.
And so I want to empower my clients who are financial advisors, like financial planners and stockbrokers. I want to empower you with the most information and knowledge that I can, so you can make the most informed decision about what's right to do with your client's capital.
Mm-hmm.
And it might mean that you don't invest in our funds, but then that's a good outcome because it means that we're not appropriate for you and your clients.
Long-term thinking.
Exactly. And yeah, and it works. But yeah, anyways.
So before we call it, I want to end on a more positive note. Can you give me some example of responsible corporate culture or corporate behavior? Because
Yeah.
I don't know many positive. I can't. I don't. You don't hear people going on the news and talking about how great this corporation is or what they did that was so productive. So you want to give me. You want to see if you could give me some positive news to end this?
Yeah, yeah, for sure. Yeah, the reason you don't hear the positive stuff is because it's kind of boring, right?
Right.
And people like hearing like the scandals and
Sure. Well, I know from my own experience as a small business, working a small business, that people only write reviews and respond to you when they're unhappy, and when they're happy, you never hear from them ever again. So I
yeah,
believe
exactly,
it.
exactly. Well, so first I would say that there are a lot more great corporate culture businesses out there than you think there are.
Hmm.
And I believe that for a business to model, a great business model to persist for a long period of time, you need a great corporate culture where all the constituents are benefiting. So, like I was saying earlier, supplier, shareholders, the senior execs, the employees, community at large, and the consumer or customer. They all need to be benefiting from it. And in the short term, the company can screw some of those constituents and make more money for themselves, but it comes at the expense of the business model in the future.
Right.
So I would I would guess that most companies understand this. A lot of private companies get it, and they share in the success of the business, particularly with their employees, and don't keep it all for themselves. And I use an example in my book of a company called Fastenal. It's based in Minnesota. It's a pretty basic business. They distribute the fasteners, screws and stuff like that. And we had a tour of their plant years ago. And the plant manager, he's taking us around, and he absolutely loves the business, and he's so excited. He said, check out these screws, our customers love us. Nobody here goofs off, because if they do, we give them shit, because it's our company, we're all in this together. It's, holy smokes, what the hell's going on here? And so I asked the guy, I said, well, why do you love the business so much? And he said, oh, it's management, ownership. They treat us so fairly. They treat us like partners. They always listen to what we have to say. And we all share in the success of the business. The more money the business makes, the more everybody makes, not just the owners and the senior execs. And then he said, here's a great example. So the CEO was the founder of the business. Right? So first of all, if you're the founder of a business, you started off on your own.
Yeah,
You're probably doing every job,
it's your baby.
right? And then as the business grows, you start hiring more people to do the stuff that you were doing, so you could do other stuff. So if you're the founder, and things aren't going right, you have more empathy for what your employees are going through because you've been there, you've done it. If
Hmm.
you're like a career executive, just come from MBA school and never started a business, you don't have that same sort of empathy. You can't because you haven't done it.
Yeah.
So that's the first thing. So he said, oh yeah, great example for you. So the CEO was the founder. He owned about a third of the business. His wife also owned a good stake in the business, but a few years prior, she had passed away. So the CEO took all of her shares and he distributed them to all the
Wow.
employees in the company.
That's shocking. That's crazy.
Yeah, no, it's a great story.
It's
And
beautiful.
I got permission from the company, by the way. I emailed them, can I use this story in my book? And they said, yeah, go ahead.
Yeah.
And but a lot more companies do that than you think. And just one other anecdotal example, I guess I was on a cruise and I was talking with a guy from England, and he was talking about his business. And I think they made furniture or something like that, or appliances. And during the great financial crisis in '08, '09, when everything turned down, sales went through the floor. And so they went to the employees and said, look, we don't want to lay anybody off. We're asking everybody to take a 10% pay cut. We, the senior management, we're going to take a 20% pay cut.
Wow.
Now, senior management can afford to take a bigger cut, but still, but we're all in this together.
Hmm.
And then once business turns around, we'll make up that 10% and more. Right? Like I said earlier, people need to know that we're all in this together. And he said over 90% of the employees agreed to take the 10% pay cut. And
Wow.
within a few years, they'd made all that up and paid them more. And there are a lot of companies out there that are like that.
Hmm.
Um, but we need more. And we
Yes.
need more high profile companies to behave in that manner. But they're not rewarded by Wall Street for doing that kind of thing.
That's the problem.
Right? They're not incentivized. And I think it was Charlie Munger. He was passed away earlier this year. He was the sidekick of Warren Buffett,
Hmm. Right.
and he had a saying. It was something like, "Show me the incentive, and I'll tell you the behavior."
Hmm.
Incentives matter,
Yes.
and you need well-structured incentives to bring out the best and the right behavior in people that will lead to longer-term success. But it might mean that in the short term, that the share price doesn't grow as quickly as you would like, or GDP doesn't grow as quickly as you would like.
Yeah. And
Those
unfortunately,
are the things.
our patience is getting shorter, not longer these days, you know? So,
Well, and it might not coincide with an election cycle or something like that,
right. Right. Something
right?
like
So
that.
I understand. It's not rocket science, um, but we do need to change it.
Yes. Paul, I really appreciate your time. This is so much fun. It's so funny because halfway through, there's another topic I wanted to talk to you about, but I guess I wanted to bring it up. Maybe we'll do it off air, and I see if you could do another recording another time about it. But this is so much fun. I really appreciate your time, and I'm going to post the link to your book and to your website, and I really appreciate this is great. This is really really useful, and what you're doing is really 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 wonderful. So, on behalf of myself and everyone else that's going to learn a lot from this, I really appreciate your time. Thank you.
Well, thank you. It's been great, Ephraim. And
Well,
yeah, we'll do it again. Just let me know. And when I'm down in Florida, I'll give you a call.
that's
Go for
well,
coffee or go
post
for
it.
a beer. I'm a bear drinker too, so
Beautiful,
go for
beautiful.
a nice beer.
All right, let me know when you're in town. Okay, I'm looking forward to it. All the best, Paul. We'll talk soon. Take care. Have a good day.